At a pharmacy counter, a retiree's card flashes copay $428 declined. 2 miles away, a CEO toasts executive bonus approved. It's the same money. The declaration came not as a thunderous command, but as a cool, rational statement delivered in boardrooms and business schools across the nation. It was a simple, powerful idea. The sole social responsibility of a business is to increase its profits. This one principle, repeated until it became gospel, ignited a revolution fought not with armies but with balance sheets, not on battlefields but on the trading floors of Wall Street. Its shockwaves are now rearranging the futures of millions, creating a stark divide between the soaring fortunes of the market and the quiet desperation of the retirement crisis. This is the story of a silent heist, a multi-trillion-dollar transfer of wealth hiding in plain sight. It is a showdown between two titanic forces, the relentless, short-term demands of shareholders and the long-term promises made to generations, with workers. Understanding this conflict is the key to understanding why the stock market can hit all-time highs while the dream of a secure retirement slips further away for so many. On one side is the engine of modern corporate finance, the share buyback, a maneuver so potent it seemingly creates value from thin air. A company uses its profits to repurchase its own shares from the open market. The shares vanish, the supply shrinks, and critical metrics like earnings per share instantly improve. The stock price climbs, executives receive massive bonuses tied to that price, and short-term investors cheer. It is a perfect self-contained loop of immediate gratification, a financial adrenaline that has become addictive to corporate America. In the last decade alone, companies have poured more than $10 trillion into this practice, a fight of cash aimed directly at boosting their own market value. On the other side stands an institution that was once the bedrock of the American dream, the pension, a solemn promise etched into the social contract between a company and its employees. Work for us for 30 years, and we will take care of you for the rest of your life. It was a model built on patience, loyalty, and long-term thinking. Companies set aside a portion of their profits year after year, creating colossal pools of capital. These pension funds were the ultimate patient investors, designed to grow slowly and steadily, compounding over decades to ensure the money would be there, without fail, when an employee finally clocked out for the last time. The pension was a promise measured in generations, a symbol of corporate responsibility and shared prosperity. For a long time, these two forces coexisted, but the gospel of shareholder value changed the rules. The pressure for immediate quarter-over-quarter stock performance became overwhelming. Long-term obligations like fully funding a pension began to look like a drag on the balance sheet, a dead weight holding back the stock price. Why tie up billions in a fund that pays out 30 years from now, when that same money could execute a buyback today, trigger executive bonuses tomorrow, and satisfy Wall Street's insatiable appetite for growth? The choice became tragically clear. A slow, methodical transfer began. Capital once earmarked for the long-term promise of the pension was rerouted to fuel the short-term thrill of the buyback. It was a death by 1,000 cuts, a gradual draining of the reservoir of retirement security to irrigate the manicured lawns of the stock market. This is the untold story of why your retirement is in a tug-of-war with the stock market, and why, right now, the market is winning. This battle for trillions is a front line in a much larger, invisible war that defines the modern economy, with outcomes that directly impact your financial security. We pull back the curtain on these conflicts, translating high finance into clear insights, to arm yourself with the knowledge needed to navigate this changing world. Subscribe now. To understand this war for capital, you must first understand the combatants. Let's begin with the old champion, the defined benefit pension. Imagine a scene from a bygone era of American industry. A young engineer sits in a wood-paneled office for his final interview. The hiring manager slides a folder across the desk. It's not just a job offer, it's a blueprint for a life, a starting salary, a path for advancement, and the crown jewel, the pension plan. The manager explains it simply. You give us your career, your loyalty, and your best years. In return, when you turn 65, we will give you a guaranteed check every month for the rest of your life. That handshake was more than a greeting. It was the closing of a covenant between labor and capital built on long-term stability. The pension was the embodiment of this pact. Its motive was security. Its timeline was a lifetime. Behind that promise stood a financial fortress. Picture a different room decades later. The company's pension fund committee is in session. These are not swashbuckling traders, but cautious stewards. Their mission is not to hit a quarterly target, but to safeguard a generational trust. On the table are actuarial reports, filled with cold data on life expectancy, inflation projections, and economic growth forecasts stretching out half a century. The discussion is measured, the analysis exhaustive. They debate the merits of investing in a new toll road versus a portfolio of government bonds. Every decision is weighed against a single question. Will this asset be safe and productive for the next 30, 40, or even 50 years? This was the slow, patient heartbeat of the Pension system, a financial machine designed to outlast recessions and market crashes. Its ultimate purpose was realized in millions of quiet moments, a retired couple at their kitchen table, opening an envelope containing their monthly pension check, the reliable fulfillment of the promise made long ago. Now, meet the challenger, a creature born from a radical shift in financial philosophy. Our scene is a sterile government office in Washington, D.C. in the early 1980s. A regulator signs a document, a new regulation known as Rule 10b-18, that creates a safe harbor for corporations to repurchase their own stock. It's a technical change, buried in legal jargon, but it effectively opens the floodgates. Before this moment, large-scale buybacks were viewed with suspicion, often treated as market manipulation, but this new rule gave them a green light, recasting them as a legitimate and efficient way to return capital to shareholders. The buyback's motive was not security, but efficiency. Its logic was seductive. Shrink the pie to make each remaining slice bigger. It didn't build a new factory or invent a new product, but it offered something far more immediate, a higher stock price. This new power thrived in a world of relentless pressure. Imagine a modern CEO on a quarterly earnings call. The questioning from Wall Street analysts is brutal. An activist investor, owning a 5% stake, sends a public letter demanding action to unlock shareholder value immediately, threatening a proxy fight to replace the board. The CEO has two proposals on his desk. One is a 5-year $2 billion plan for research and development, a risky bet that might pay off in a decade. The other is a plan to spend that same $2 billion on a massive share repurchase which will boost earnings per share by 8% next quarter, almost guaranteeing the stock will rise. The pressure is immense, the choice clear. An order is sent to the company's investment bank on a trading floor in New York. A trader's algorithm executes the command, acquiring millions of shares. The effect is instantaneous. The stock closes, up 3%. The CEO's bonus, tied to share performance, is secured. The activist investor is satisfied. The buyback has delivered a quick, decisive victory in the endless battle for short-term results. The two philosophies were now on a collision course, and the first casualty was the pension's fortress of security. Let's return to the pension committee room, but the mood is now tense. An actuary stands before the board, his presentation filled with charts sloping downwards. He explains the brutal math. Low interest rates have crippled the funds expected. Returns, people are living longer than the models predicted. But the final blow is a single number on the screen, the funding gap. It's the chasm between what the pension has and what it has promised to pay out, a multi-billion-dollar deficit. The actuary's recommendation is direct. The company needs to increase its contributions significantly for the next 10 years. The committee members know the company just reported record profits. They also know where that money is going. The decision is not made in their room, but in the C-suite, where the language of long-term obligation is drowned out by the roar of the market. The CEO and CFO review the capital allocation plan. The pension deficit is a line item, a liability to be managed. The dominant topic is the stock price, which has lagged behind competitors. The CFO puts up a slide with 2 columns. Column A is titled Pension Remediation. It shows a decade of heavy cash outlays, a corresponding dip in reported earnings per share, and a stock performance model that flatlines. Column B is titled Strategic Capital Return. It shows a massive front-loaded share repurchase. The impact is immediate, a double-digit jump in earnings per share, a favorable recalibration of all key financial ratios, and a performance model showing the stock price ascending sharply. The choice presented is not between right and wrong, but between stagnation and growth. The fallout from that decision happens in a sterile conference room, far from the executive floor. A grim-faced human resources manager addresses a group of 50-year-old factory workers. He reads from a script, speaking of modernizing retirement benefits and offering greater flexibility and control. The defined benefit pension plan will be frozen. No new benefits will be accrued. All employees will be moved to a 401k plan. The promise of a guaranteed check for life is gone, replaced by an account whose future value depends entirely on the whims of the stock market. The risk has been officially transferred from the corporation to the individual. The covenant, sealed with a handshake decades ago, has been unilaterally amended. The final scene of this transfer plays out not in a boardroom but at a kitchen table. A retired machinist who gave 40 years to the company opens a letter. It's a formal notice that his future pension payments will be less than he was promised, due to a recalculation of plan assets and liabilities. On his tablet, a news alert pops up. It's a celebratory article about his former employer, praising the CEO for another quarter of delivering shareholder value through an aggressive and successful stock buyback program. The two documents sit side by side, one a diminished promise, the other a triumphant boast, both paid for from the same pool of corporate profit. This is the heart of the conflict. It is a clash of timelines and a battle over who bears the risk. The pension is a financial marathon runner. The buyback is a sprinter, built for the next 100-yard dash of a quarterly report. These two worlds cannot peacefully coexist when competing for the same finite pool of capital. One must inevitably starve the other. The engine driving this historic transfer of capital is not run on malice, but on incentives. Perfectly rational, exquisitely designed incentives that make the choice to favor buybacks over pensions seem not just logical, but necessary. Our next scene takes place in a corporate boardroom, but the real power is held by a visitor. He is a compensation consultant, his job to design the CEO's pay package. On a large screen, he displays a series of complex charts. The language is a sterile blend of corporate jargon, total shareholder return, performance-based equity, and aligning executive interests with shareholders. He walks the board through the proposal. The CEO's salary is a minor component. The real prize, worth tens of millions of dollars, is in stock options and performance awards, triggered by hitting specific targets for earnings per share growth and relative stock performance. Against a peer group, that consultant doesn't need to say buyback. Everyone in the room understands the mechanism. A share repurchase is the most direct, reliable way to increase earnings per share. It requires no innovation, no risk, no long-term investment. It is a simple accounting maneuver that directly enriches the person in charge. The board members nod. They are fulfilling their fiduciary duty to incentivize performance. In reality, they are forging a golden link between the CEO's personal fortune and the company's stock price, creating a powerful motive to prioritize the short-term metric over the long-term promise. The pension funding gap doesn't appear on any of the consultant's slides. It is an unmeasured, and therefore unrewarded liability. This internal incentive structure is amplified by an army of external validators. Picture a young analyst at a prestigious investment bank, working late into the night. His screen is filled with a financial model of a major industrial company. He plugs in the latest quarterly numbers. The model spits out a valuation suggesting the company's stock is trading at a discount to its peers. He needs a catalyst, a reason to tell the bank's clients that the stock is poised to rise. He runs a new scenario, modeling the impact of the company diverting its free cash flow from debt repayment and pension contributions into a new aggressive buyback program. The results are immediate. The model's earnings per share forecast jumps. The valuation metrics improve dramatically. The stock now looks like a compelling opportunity. He begins to write his report, praising the company's disciplined capital allocation and highlighting the potential for significant capital returns to shareholders. The report is published, and thousands of investors read it. The pressure on the company to do exactly what the analyst modeled intensifies. The system justifies itself. And what happens when this game goes on for too long? Our final scene is a quiet government office, home to the Pension Benefit Guaranty Corporation. This is the agency that steps in when a company fails and its pension plan is left behind. An auditor sits at a metal desk, surrounded by boxes of documents from a recently bankrupted retailer. He reviews a summary sheet. In the 5 years leading up to its collapse, the company spent over $4 billion on stock buybacks, even as its sales declined and its debt mounted. In that same period, it underfunded its pension plan by nearly $1 billion. Now, the company is gone. The executives who presided over the buybacks left years ago with their bonuses. The shareholders who benefited have long since sold their stock. All that remains is the broken promise. The auditor makes a final calculation. The agency will cover a portion of the pension, but the retirees, after a lifetime of work, will receive only a fraction of what they were promised. The risk the corporation shed was not eliminated. It was simply transferred to its former employees and to the government. The gains were privatized, the losses were socialized. This is the final brutal logic of the showdown between the long-term promise and the short-term reward. The showdown between the pension and the buyback is not merely a contest between two financial strategies. It is the visible manifestation of a much deeper tectonic shift in the very purpose of the economy. This is the transition from a productive economy to an extractive one. For generations, the dominant model was production. A company's success was measured by what it built, what it invented, and the stable employment it provided. Profits were a means to an end to invest in better factories, groundbreaking research, and a secure workforce, creating a virtuous cycle of growth and shared prosperity. But the rise of the buyback signals a new philosophy. Today, success is often measured by what can be extracted from a company for the benefit of its shareholders as quickly as possible. The company itself is no longer the project. It is a resource to be harvested. This shift has profound concrete consequences that extend far beyond the balance sheet, reshaping our economic landscape. The first and most direct consequence is the staggering opportunity cost. The trillions spent on share repurchases over the past 2 decades were actively diverted from other uses. This is capital that was not invested in the patient, long-term research needed for the next generation of life-saving drugs or breakthrough technologies. It was not used to build modern, efficient factories in America, leaving critical supply chains brittle and dependent on foreign rivals who were playing a longer game. It was not used to increase wages at a rate that kept up with productivity, nor was it used to pay down the mountains of corporate debt that now make the entire system more fragile. For every dollar spent engineering a short-term rise in the stock price, there was a dollar not spent on the long-term health of the business and the broader economy. This has created a corporate sector that is, in many ways, an empty fortress. The walls look high and the banners fly proudly in the form of record stock prices, but inside, the foundation of future innovation and resilience has been quietly eroded. The second consequence is a radical rewriting of the social contract and an explosive widening of the wealth gap. The decline of the pension and the rise of the 401k represents one of the largest transfers of risk from institutions to individuals in modern history. A generation ago, the risk of outliving one's savings or a market downturn in retirement was borne by the corporation. Today, that risk rests almost entirely on the shoulders of the individual worker. This has created a dangerous paradox. Millions of Americans are now forced to be amateur investors in a stock market whose gains are increasingly fueled by the very corporate behavior that dismantled their old safety net. They are tethered to a system where their own retirement accounts growth is fueled by the corporate practice that destroyed the very concept of a secure retirement in the first place. The rising market, therefore, no longer signals broad-based prosperity. Instead, it illuminates a growing chasm. The benefits of buybacks flow overwhelmingly to the top 10% of the population, who own the vast majority of stocks. For everyone else, the soaring market is a constant reminder of a system that prioritizes shareholder returns over wage growth and capital gains over retirement security. Finally, this obsession with buybacks injects a huge amount of systemic risk into the economy. To fund these massive repurchase programs, corporations have taken on unprecedented levels of debt, especially when interest rates were low. They have effectively traded resilient balance sheets for higher stock prices. This leaves them dangerously exposed when a crisis hits. A company with little cash and a mountain of debt has no shock absorbers. At the first sign of a recession, their only options are mass layoffs and, in many cases, government bailouts. We saw this play out with stunning clarity during the pandemic, when industries that had spent years prioritizing buybacks over cash reserves were the first in line for taxpayer-funded support. This creates a perverse cycle of moral hazard. In good times, profits are funneled to shareholders via buybacks. In bad times, the losses are socialized. The conflict between pensions and buybacks, therefore, is ultimately a battle for the soul of the economy, with stakes that define who prospers, who is left behind, and who ultimately pays the price. This transformation from a productive to an extractive economy fundamentally corrupts the purpose of the stock market itself. Historically, the market was a mechanism for capital formation. Companies went public to raise money from investors to fund expansion, hire people, and create new products. Capital flowed from savers into the productive heart of the economy. The rise of the buyback has, for a huge swath of the corporate world, reversed this flow. The stock market is no longer primarily a source of capital for companies. It is a mechanism for companies to disgorge capital to shareholders. The river is flowing backwards. Instead of funding the future, the market is now a tool for liquidating the present. This creates a dangerous disconnect where the stock market can thrive even as the underlying real economy stagnates. The stakes of this backward-flowing river are measured in national competitiveness. While American corporations have been spending trillions to repurchase their own shares, their global competitors have often been playing a different game. They have engaged in the patient, long-term work of building strategic industries, dominating supply chains, and investing heavily in the technologies that will define the 21st century. When a nation's largest companies consistently choose financial engineering over foundational research, they are making a strategic choice to trade long-term leadership for short-term market approval. The result is a hollowing out of industrial capacity and a growing dependence on other nations for critical goods, from microchips to medical supplies. The soaring stock market, in this context, can be a misleading indicator, masking a slow erosion of the country's economic power and technological edge, but the most immediate and painful consequences are felt at the human level. In the quiet, the collapse of retirement security, the traditional three-legged stool of retirement to pension, personal savings, and social security was designed for stability. By systematically prioritizing buybacks, corporate America has effectively sold off the pension leg for the majority of private sector workers. This has placed an impossible weight on the other two legs. Personal savings, now held in market-dependent 401k plans, are vulnerable to the very volatility that buybacks can exacerbate, and Social Security, never intended to be a sole source of income, is strained under the growing burden. The concrete result is a retirement crisis that is no longer a future threat, but a present-day reality for tens of millions. It is the 60-80-year-old stocking shelves at a big box store. It is the 72-year-old driving for a ride-sharing app. It is the widespread fear and uncertainty that has replaced the promise of a dignified and secure old age. Ultimately, the conflict between buybacks and pensions forces a decision about what kind of economy we want. Is it an economy that rewards the patient creation of value, or one that incentivizes its rapid extraction? Is its purpose to build resilient enterprises that provide stable careers and secure retirements? or to generate maximum short-term returns for an ever-churning market. The current trajectory, dominated by the buyback, has provided a clear answer. It has created a system that is incredibly effective at generating spectacular wealth on paper, reflected in record-breaking stock market indices. But it has done so at the cost of hollowing out the real economy, fracturing the social contract, and transferring immense risk onto the shoulders of ordinary people. The rising market, in this light, is not a sign of universal health, but a fever chart of an economy consuming its own future. The attack on the old order was not a frontal assault, but a campaign of sophisticated arguments, each designed to make the prioritization of buybacks seem not just profitable, but intellectually sound. The first and most powerful argument was one of discipline. Proponents claimed that share repurchases were the ultimate check on managerial excess. A company with excess cash, they argued, should be forced to return it to its rightful owners, shareholders who could then reinvest it more efficiently in other, more promising ventures. It was a clean, market-driven solution to prevent corporate bloat and the squandering of profits on wasteful projects. But the first receipt to challenge this narrative came from the company's own spending records. A landmark, multi-decade study of thousands of public firms revealed a startling inversion. For the first time in modern history, the largest corporations began spending more of their profits on financial engineering, buying back their own stock, than on the foundational pillars of their own future, research and development and new capital expenditures combined. The data was undeniable. Capital was not simply being returned for more efficient use elsewhere. It was being actively diverted away from internal investment. The reaction from the corporate world was not introspection, but acceleration. Buybacks became a badge of honor, a signal of strength and confidence, proof that management was laser-focused on shareholder value. This led to the second line of attack, the argument of scarcity. Executives began to claim they had simply run out of good ideas. "We are funding all of our profitable investment opportunities," became a common refrain on earnings calls. "The buyback is what we do with the leftover cash." It painted a picture of a corporate landscape so saturated with success that there was simply nowhere left to productively invest. Yet another set of books told a different story. While CEOs were claiming a surplus of cash with no home, the internal ledgers of their own pension plans showed a gaping hole. Government data, compiled from mandatory corporate filings, revealed a collective pension funding deficit that had ballooned into the hundreds of billions, and eventually, over $1 trillion. The leftover cash had a name, and it was the money contractually promised to their retirees. The argument of having no good place to invest was a fiction. There was a legally binding obligation right on their balance sheets that they were actively choosing to neglect. Corporate reaction to this damning contradiction was not to fill the hole, but to get rid of the promise. A wave of pension freezes swept across the country. The problem wasn't solved. It was offloaded onto employees, conveniently removing the glaring pension deficit from the list of things the leftover cash could be spent on, clearing the path for even more buybacks. This leaves one final, sophisticated defense standing. Proponents argue that buybacks are simply a more tax-efficient form of dividends. The money still flows to shareholders, who, as the ultimate owners and risk-takers, are the most capable stewards of that capital. They, in turn, will reinvest it wisely, funding the next generation of innovative companies, creating a more dynamic and productive economy for all. It is the last intellectual pillar holding up the entire multi-trillion-dollar edifice. But the receipt for this final claim is perhaps the most damning of all, found not in corporate filings but in the records of who actually owns the stock and what they do with the proceeds. The takedown begins by looking at the first and most immediate beneficiaries, corporate insiders. An analysis of regulatory filings reveals a consistent and lucrative pattern. In the days and weeks following a major buyback announcement, there is often a surge in stock sales by the company's own top executives. The buyback, funded by the company's profits, creates a temporary lift in the stock price, which in turn creates the perfect window for executives to cash out their stock options for maximum personal gain. The capital isn't being returned to shareholders for reinvestment. It's being converted directly into executive compensation. It is a wealth extraction machine, disguised as a capital allocation strategy. So what about the other shareholders, the large institutions and individual investors? Where does their money go? Here, the second receipt delivers the final blow to the reinvestment myth. Detailed studies of capital flows show that the proceeds from buybacks do not, in large part, flow into venture capital or the funding of innovative, new startups. Instead, the vast majority of this capital flows right back into the public stock market, chasing the same pool of large, established companies that are also engaged in buybacks. It creates a massive self-referential feedback loop. Company A buys back its stock, raising its price. Capital from the subsequent sale of Company A's shares is then used to acquire shares in Company B, whose stock is also appreciating due to its own buyback program. This cycle does not create new productive capacity. It doesn't build anything. It simply inflates the value of existing assets. making the entire market more concentrated and more fragile. The theory of efficient reality of capital was a powerful argument, but the evidence shows a different reality. The money is not being efficiently it is being concentrated, enriching the current generation of insiders and asset owners. With its primary justifications dismantled, the buyback argument retreats to its last fortress, the claim that a repurchase is the ultimate signal of management's confidence. The logic is appealing. Who knows the true value of a company better than its own leaders? When they acquire their own stock, they are sending a message to the market: our shares are undervalued. It is a powerful narrative, casting the CEO not as a financial engineer, but as a conviction-driven leader, making a bold bet on the company's future. But the receipts from decades of market cycles tell a story not of shrewd timing, but of cyclical miscalculation. A forensic analysis of corporate repurchase programs over multiple economic cycles reveals a stunning and consistent pattern. Corporations overwhelmingly repurchase their shares when the price is high, at the peak of bull markets, when cash is plentiful and optimism is rampant, and when the market contracts and their stock is genuinely cheaper, they are forced to stop. They purchase shares most aggressively at market peaks and cease their acquisitions when prices are depressed, a pattern that results in a net reduction of corporate capital over time. The airline industry provides a perfect, brutal case study. In the decade leading up to the 2020 crisis, major U.S. airlines spent, on average, 96% of their free cash flow on stock buybacks. They spent tens of billions of dollars repurchasing their own shares at historically high market valuations. When the pandemic hit and their revenue collapsed, they had no cash reserves. They were the first in line for a multi-billion-dollar government bailout, funded by the same taxpayers whose retirement security was being eroded by the very system the airlines had perfected. The confidence signal was a mirage. It was not a bet on the future, but a celebration of a fleeting present, with no thought given to the inevitable storm on the horizon. The buyback is no longer a strategic choice. It is a compulsory ritual. The final unspoken truth is the complete inversion of the confidence argument. Companies are no longer buying back stock because they believe its price is low. They are buying back stock in a desperate attempt to make it appear valuable, to hit the quarterly earnings per share target that unlocks the executive bonus pool. The signal is not one of genuine confidence, but of manufactured compliance, stripped of its economic justifications. The buyback ideology makes its final stand with a plea of helplessness. The defenders claim that corporations are not the architects of this system, but its captives. Their hands are tied, they insist, by the relentless pressure of Wall Street and a new breed of aggressive activist investors. In this telling, the CEO is a tragic figure, forced to choose between launching a buyback to appease the market or watching an activist tear the company apart. The decision is not a choice, but a defensive necessity. But the first receipt that unravels this narrative of victimhood is the sheer programmatic scale of the operation. An examination of corporate filings reveals that buybacks are not typically sporadic, reactive measures to an activist attack. They are massive, multi-year, multi-billion-dollar authorizations, planned and baked into the corporate budget far in advance. They have become a standard, unquestioned line item in capital allocation. This is not the behavior of a company under siege, it is the calculated long-term strategy of an institution that has fully embraced the buyback as its primary tool for managing its stock price and its earnings. The second receipt is found in the very architecture of corporate power. The idea that an outside activist is forcing an unwilling board to do something it doesn't want to do ignores a fundamental reality. The board and the activists often want the exact same thing. The compensation structures that lavishly reward executives for hitting short-term stock metrics are not designed by activists. They are designed by the board's own compensation committee. The pressure from Wall Street is not an alien force. It is a welcome tailwind, pushing executives in the direction their own pay packages are already incentivizing them to go. The investor is not storming the castle. They are often being invited into the throne room because their demands align perfectly with the personal financial interests of those in charge. The final takedown of the helplessness plea comes from the simple existence of those who chose a different path. A small but significant number of corporations across various industries have consistently resisted the siren song of the buyback. They have publicly and repeatedly stated that their cash is better spent on research, on expanding their business, and on their employees. They have weathered the criticism of analysts and have, in many cases, gone on to create immense long-term value, proving that the pressure to perform financial alchemy is not an iron law of nature. It is a choice. The existence of these counterexamples proves that the "our hands are tied" argument is a myth. It is the final, convenient excuse for a system that has chosen the path of extraction over production, and short-term gain over long-term obligation. The fallout arrives not as a single, cataclysmic event, but as 1,000 daily tremors, a slow-motion earthquake reshaping the landscape of American life. The montage begins on a 24-hour business channel. The ticker is a river of green. The anchor celebrates another record high for the market, fueled by strong corporate earnings and a massive wave of shareholder return programs. The screen cuts to a triumphant CEO ringing the opening bell, confetti raining down on the trading floor. It is a spectacle of pure success. But on another screen, a local news channel broadcasts from a grim union hall in the Rust Belt. The fluorescent lights hum over faded banners and folding metal chairs. Hundreds of retired factory workers sit in stunned silence. A union representative is at the podium, his voice heavy, explaining that their former employer, after filing for bankruptcy, is handing its pension obligations over to the government. The promise has been broken. The checks will be smaller. The camera pans across the faces of men and women in their 70s and 80s. Their expressions a mixture of fear, betrayal, and quiet disbelief. The two scenes, the confetti and the collapse, are happening on the same day, in the same country. Products of the same economic engine. The tremors ripple outward. A grainy cell phone video goes viral. It shows a former airline pilot, a man who once commanded a jumbo jet, now driving for a food delivery service. He speaks directly to the camera, his voice steady but laced with anger. He holds up two documents, a letter announcing a 20% cut to his pension, and a news clipping from the previous year detailing his former company's $5 billion stock buyback. The video explodes. The comment section becomes a national support group, a digital wall of grief filled with thousands of stories from teachers, machinists, and truck drivers, all echoing the same refrain. They took our future, and they bought their stock with it. The political world is forced to react. A congressional hearing is convened, its title promising accountability. Executives are called to testify. They speak in the calm, measured tones of corporate responsibility, blaming low interest rates, global competition, and unforeseen market forces. They are met with theatrical outrage from lawmakers, who condemn corporate greed and short-termism for the cameras. Weeks later, a piece of legislation is passed. It doesn't ban the practices that led to the crisis. It imposes a tiny 1% excise tax on stock buybacks, a fee so small it is immediately absorbed as the cost of doing business. The system has been performatively scolded, then allowed to continue, unchanged. The aftershocks continue, but they become the new normal. The headlines about pension defaults and worker protests fade, replaced by the endless hypnotic hum of the market. A new record is set. For the first time, American corporations spend over $1 trillion on buybacks in a single year. The news is reported not as a crisis of investment, but as a landmark achievement, a sign of a healthy and confident corporate sector. The outrage has been metabolized into a statistic. The machine no longer needs to defend itself. Its dominance is simply an accepted fact of the modern economy. The fallout is most profound for those who never even knew the old promise. In a sleek, glass-walled office, a group of new hires, all under 30, sit through their benefits orientation. The presentation is upbeat, filled with graphics of mountain climbers and sailboats. They are shown how to enroll in their 401k, how to choose from a menu of mutual funds, and how the company's stock options plan works. The word pension is never uttered. It is an artifact from a different civilization for this generation. The idea of a company guaranteeing a secure retirement is as foreign as a rotary phone. They have been born into the new contract. The company offers a salary and access to the casino of the stock market. All the risk is theirs. The hypocrisy of the system is laid bare in a single, brutal sequence of events. Following a major corporate tax cut, politicians promise a new dawn of American investment. The windfall, they claim, will be used to raise wages, build factories, and create jobs. 1 year later, the official numbers are released. A major aerospace manufacturer, a recipient of billions in tax savings, is revealed to have spent nearly all of its windfall on a record-breaking stock buyback. Weeks after that announcement, another headline appears. The same company is laying off 10,000 skilled engineers and factory workers. The fallout is a perfect closed loop. The public subsidizes the corporation. The corporation uses the subsidy to enrich its shareholders, and the public is then left to support the workers the corporation just fired. The final image of the fallout is one of profound and growing divergence. A financial news channel shows a split screen. On the left, a chart of the S&P 500, an almost vertical line of ascent, a visualization of trillions in paper wealth. On the right, a different chart, the labor force participation rate for Americans over the age of 65, a number that has been steadily, relentlessly climbing for 2 decades. The two charts are a perfect mirror image of the same story. One line represents the spectacular success of the extractive economy. The other represents the human cost. It is the story of a nation where the stock market has never been richer, and retirement has never been more precarious. That the great divergence between soaring stocks and shrinking pensions is no accident. It is the result of a deliberate choice, a fundamental redefinition of corporate purpose away from long-term value creation and towards short-term value extraction. This invisible war for capital has created a two-tiered economy, one of spectacular paper wealth for the few, and another of precarious reality for the many. But this entire system relies on the silence of its designated watchdogs. The executives make the choices. but who validates the books that allow these choices to be made, to understand how the official guardians of financial integrity have repeatedly failed to prevent corporate disaster. Open the on-screen card to watch our video now. 3. Auditors' failures where they slept big for